I would also like to take this special moment and give a very, very big shout out to Dan Spuller, a good friend of ours at the Unitize, who's the co-chair of the North Carolina Blockchain Initiative, for helping us put the following sessions together. Everybody enjoy.
Well, good afternoon, everybody, and thank you for joining us for this panel, which is exploring U.S. central bank digital currency with the Digital Dollar Foundation founders, Christopher Giancarlo and Daniel Gorfine. So thank you both, gentlemen, for being here today. Really appreciate it, and excited about the opportunity to speak with you.
Good to join you.
Yeah, thank you. Thank you. I'd like to start off because we have a diverse audience with varying levels of understanding of this subject matter. So I think it might be helpful to set a baseline by giving everybody a very brief overview of your impressive backgrounds and a high-level overview of the Digital Dollar Foundation. And maybe we could start with you, Chris. And I think it's obviously important to talk about your most recent government roles as well.
Yeah, thanks, Kevin. It's great to see you. I spent 5 years from 2014 to 2019 at the U.S. Commodity Futures Trading Commission. And for the second half of that period, I served as its chairman. Before that, I spent 30 years in the private sector, almost half of that time practicing law in New York and London, and then starting a startup company, GFI Group, that developed some of the first electronic trading platforms for over-the-counter derivatives. And we took that company public in 2005, and I had a very successful run. We became the world's leading trading platform, operating out of 18 major world financial centers, operating a network of trading for over-the-counter swaps. And that was my background, both as an entrepreneur and in financial markets before going to the CFTC. I stepped down. I finished my term after 5 years last July and re-entered the private sector. And everything that I'm doing in my work in the private sector really is focused on that junction between markets, between technology and law and public policy. And I'm very focused on areas where so much of our financial infrastructure that was once state of the art has been allowed to age and decay, in some cases become obsolete. And this is a critical issue as we enter this new digital age, an age of the digitization of things of value. And last October, I teamed up with Daniel Gorfine, who will introduce himself in a second, and we wrote an op-ed in the Wall Street Journal on why we believe the dollar as one of those core elements of infrastructure need to be modernized for a new digital era. And that led us in January of this year to form the Digital Dollar Foundation, which we'll talk about in a minute. But I'll let Daniel speak about some of his background and why he's involved in this great adventure alongside me.
Great. Thanks so much, Chris. And Kevin, good to see you at least virtually. So those of you who like the movie Memento and like going in kind of reverse chronological order, that's how I'll walk through my background. I actually left the CFTC last summer and launched a boutique fintech advisory and consulting business. Also glad to be here in my capacity as one of the co-founders of the Digital Dollar Project. I also currently serve as adjunct professor at Georgetown University Law School, where I teach fintech law and policy. Before that, though, back in 2017, I was fortunate to have joined the CFTC and worked with former chairman Chris Giancarlo to head up Lab CFTC, which was the agency's financial technology and regulatory innovation office that Chairman Giancarlo spearheaded and launched with bipartisan support amongst the other CFTC commissioners. So a fascinating opportunity to help build out a bit of a model or a blueprint for how federal regulators can engage with emerging financial technologies. Before that, I actually served at a fintech company that went public back in 2014, where I was the head of external and regulatory affairs. And prior to joining that company, I actually had been in think tank world for a while, where I focused heavily on access to capital and built out one of the first fintech programs that kind of explored how some of these innovations are impacting existing rules and regulations and policy frameworks. I'm also an attorney by background. I did start my career at a law firm in Washington, D.C. But very much looking forward to joining you for this discussion. And, I'll say for my 2 cents here in terms of why the Digital Dollar Project and working with Chris in this capacity seems so important and of interest to me. And it really ties to the basic idea. We'll come back to this theme time and again, but for many of the viewers today, this won't sound like rocket science, but it's the understanding that computers are connected to each other by the internet. And that means that we know we can send information halfway around the world today with very few intermediaries at very low cost and with great efficiency. And I think, what Chris and I and his brother and some of our partners at Accenture believe is that things like tokenization and blockchain and DLT stand for the proposition that you can send now information about value and about unique ownership of value the same way halfway around the world with relatively few intermediaries at low cost and with great efficiency. And that dynamic is going to impact the way we transact in all types of financial instruments, including money. And so that's what got us thinking last fall, as Chris mentioned, about how this dynamic and how these trends are going to impact the US dollar itself. And we thought that was a very important project for us to tackle in a nonprofit kind of thought leadership way.
Excellent. And you have spent a considerable amount of time, both of you, thinking about this. You recently published your white paper, and I think to further set the stage, it would be great if you could kind of at a high level walk through the white paper, and it's available publicly online for folks who have not read it. But to walk through it and also talk a little bit about the difference between a central bank digital currency, or in this case, the digital dollar, and a stable coin, like TrueUSD or Tether, because I've been on phone calls or conference calls when this issue's come up, and it was surprising to me that there is a lot of misunderstanding out there about the difference between a stable coin and a digital dollar. So if you could kind of talk about the white paper and then maybe hit that point too, it'd be great.
Great. So maybe what we'll do, Kevin, is maybe I'll take the first part of the question, and then I'll pass the baton to Daniel to address the second part. And the first part is that we formed the Digital Dollar Foundation and then teamed up with Accenture to create the Digital Dollar Project in January of this year, 2020. And then we set to work building an advisory board of individuals, of some of the leading experts in a range of areas, from central banking to commercial banking, from privacy issues to law enforcement and AML KYC issues, to, as I say, a range of subject matter. And then we sat down with them in a series of virtual meetings to come up with what we identify as a champion model for a US central bank digital currency. And when we say a champion model, what that acknowledges is that there's many roads to achieve this. What we wanted to find is, where is the middle ground? Where is the most achievable, the most effectuous representation of this? And then put it forward in a thoughtful work, which is our white paper, which we released at the end of May, and ask others to come in with challenges to this model and tell us whether indeed it is the right, or whether there are elements of this that are better represented in other models. But what we're seeking to do is form public opinion, a consensus around a model for the US to then perceive. When in the 1950s, when Russia launched Sputnik, the United States wished to respond. It wasn't right away clear that the response would be landing a person on the moon. That what became the champion model, but after a search for consensus. And what we're trying to do here is find that consensus. So we put forward our champion model in our white paper, which is viewable at digitaldollarproject.org. And we invite your listeners to read it and think about it, because ultimately what we want to arrive at is, what is the best way forward? What is the best way forward to modernize the dollar for a new digital age, an age in which things of value will become digitized, decentralized, and ultimately programmable? How do we have them interact with a fiat currency that has those similar properties of digitization and programmability? So what we have proposed in the digital dollar is, one, that the dollar be in a tokenized form, not an accounts-based form. Now, there are those who argue that accounts-based might be a way to go. We view it as something of half a loaf. And if we're going to modernize the dollar for a new digital age, let's go the full representation of a token. We're open to conversation on that, but that is what is our champion model. We also propose that it should be distributed through the existing bank infrastructure in the same way that fiat money is made available now from the central bank, through regional banks, through commercial banks, and then distributed to the public. And the banks post reserves against that fiat currency. We're proposing the same distribution mechanism here. We're also proposing that it is not to the exclusion of stable coins and other non-sovereign currencies. And we're also proposing that it doesn't displace existing paper fiat that's in existence in currency. And perhaps here's a good point for me to pass the baton to Daniel to talk about how it's different than, say, stable coins.
Yeah. No, thank you, Chris. I think that's a great overview of some of the key tenets and the perfect segue, because again, and that's actually one of the stated explicit tenets of the Digital Dollar Project, is that a tokenized US dollar is not antithetical to further private sector innovation, including things like stablecoins. If anything, as I'll explain in a second, we think it's additive. I mean, at the end of the day, the system around money, if you view the system around money as a public good and as basic infrastructure that you then build upon, I think it helps explain how upgrading that infrastructure can help unleash additional innovation. So how might that happen? So the first one is around programmability. So when you talk about tokenization, if you tokenize the US dollar, we don't believe that the government is going to be in the business of creating significant code and rules within the token itself. To the extent they do so, it would be minimal. The role of the private sector will be to add kind of wrappers around that, or essentially smart contract systems around the tokenized money, which will enable all types of different types of business use cases and applications. So you can think about, for example, settlement in financial markets or in capital markets transactions, where perhaps you don't want real-time settlement. There may be efficiency benefits from having slight delays, but that's code and that's logic that the private sector may develop around USD in order to help satisfy that particular application. Another way to think about this is that I was trying to come up with analogies when you look at the infrastructure argument, and you could think about the system of money as akin to highways. When the US government decided to build interstate highways, did it have an impact on certain transport businesses? Of course it did. It had an impact because it was a choice to make big, at the time maybe it was only 2-lane, but to make wider lane interstate systems. But what did that do? It enabled significant economic activity and new transport businesses to build on top of that. So again, holding that parallel, you can see how tokenizing the US dollar should enable a lot further innovation in economic activity around payment structures. Today we've made a design choice. We have physical cash. That's the choice we've made. We have, as a result of that, an ATM system that's developed. We have different types of payment systems that have developed to fill gaps and build on top of that. The same thing would happen if you upgrade the system to tokenize money, but we think with even better benefit to markets, to individuals and end users.
Well, so I would actually like to talk more about some of those benefits. And I think you've already touched on some of those benefits. And maybe, Chris, you could talk at a high level about some of the types of things that we might see. And I mean, one of them obviously that comes to mind, I think, for most people in the United States is competitiveness of the US dollar on a global playing field. But if you could talk about some of the kind of an overview of some of the benefits, and then maybe Daniel, you could dig in, or Chris, however you guys want to address it, but could dig into some of the specific use cases or types of benefits that we might see from a digital dollar. Maybe some examples of how someone might program a digital dollar to do some new and innovative things that we can't currently do with a greenback.
Sure. So just broad overview, right? Most money that's utilized today is bank money, is bank issued money in the form of accounts. And that system, which goes back to the 17th century Amsterdam accounts-based system, is a system that requires an enormous amount of message activity, signaling, account reconciliation activity before the actual transfer of money takes place. That system, as much work has gone into modernizing it to keep it a pace of human progress, is still a system that is relatively expensive. It's relatively slow, relatively, and it's relatively exclusionary, as we've seen in the COVID crisis when we recognize how much of our society is unbanked. We have the opportunity with new digital technology and the development of distributed ledger technology to move to a token system that will be faster, be less expensive, and could be more permeable to populations that have historically been excluded from accounts-based system. That's the broad overview. Once you then start going down to different use cases, whether they be in retail payments, retail benefits distribution, retail compensation distribution, whether it be in wholesale transactions, merchants in business having access or the ability to transfer capital in large amounts, not just small amounts, in large amounts. And then finally to international payments. There's a myriad of improvements from retail across to large institutional wholesale. But ultimately, it's about modernizing the infrastructure. If we were going to build a US dollar account system today, would we build it the way it's been built and layered on top for several centuries? Or would we start with this new technology that allows for direct money transfer in the form of tokens? That's what we're calling on. It's the same reason, Kevin, why every so often we need to rebuild our airports, because they were built for a former period of time and don't serve as well in a new period of time. It's a reason why we rebuild our transportation system. It's about core architecture. And we know that when we upgrade architecture, businesses build on top of that, and commerce thrives, and wealth is created, and economic growth takes place, and jobs are created. This is about infrastructure. It's about national infrastructure and about modernizing it for a new age and a new time.
Yeah, I think that's really well put. So I'm not going to spend too much time, layering on top of that. But I think that one thing I would add is that through the Digital Dollar Project, we're really large proponents of pilots and real world trials so that we can test the benefits of tokenization in these different types of kind of bucketed use cases or applications. So Chris outlined, there's retail payments, there's wholesale, there's international applications. I'm going to drill down for a second on the retail front of what's interesting. One thing that we think this would do is it creates an alternative set of payment rails for small business owners, for merchants who may be able to now accept digital cash alongside other types of payment systems. Competition typically benefits the consumer and the end user, could drive down certain costs and friction points that exist within the current payment system. The other area that's really interesting is around access and inclusion, and Chris started getting into this idea, but that's basically driven. Our hypothesis is that the lower cost of operating a token-based system, as well as the idea that digital wallet service providers may be able, and again, this is why we need to test and actually see this in the real world, but may be able to offer digital wallet services at lower cost from a technology and operations and a regulatory perspective than a traditional bank account. And if that's true, if you can offer kind of this very focused type of a service at quite low cost, then you can imagine it becoming ubiquitous on smartphones. I mean, some of the data is quite interesting. I think Pew found that 60% of the or underbanked population has a smartphone. So you can imagine a digital wallet service coming preloaded with, a smartphone coming preloaded with digital wallet services, which could allow for onboarding underbanked populations and to have access to digital cash. Currently, physical cash is the choice payment system for many, but that doesn't enable you to actually participate in a digital economy. So that's an area as well that we think is quite interesting to take a look at.
Yeah, I mean, as I was reading through your paper, and I think you had a reference to it, in one of the COVID relief bills, there was a one that didn't pass, but a provision that would tell the guardians a slightly different idea, but let's have a digital payment for COVID relief, so that I could see a benefit. You could program that dollar for supplemental nutrition assistance or COVID relief assistance or things like that. Seems like there's a lot of benefits to having a dollar that can move electronically. So a digital dollar is a real dollar. It's not like a stable coin or representation a token backed by a dollar somewhere else. It is a dollar, just like a piece of paper money. And when I'm thinking about, there's lots of potential benefits. As with everything, there's also potential concerns or drawbacks. I can't think of anything that's more private than a transaction with a paper dollar bill. I can hand it to you, and you and I are the only two people that know about the transaction unless we broadcast that or do it publicly, something like that. So with a digital dollar, presumably there is a digital record of its movement, and that has benefits, but also certainly some privacy concerns. So could you talk about some of the potential concerns that a digital dollar would raise, and sort of how you are going, approaching that issue and trying to navigate that? And I'm thinking like Fourth Amendment privacy concerns, that kind of thing.
Sure. So you're absolutely right, Kevin, that the big distinction between a central bank digital currency and, say, a stable coin is that a central bank digital currency is an obligation of the central bank, as opposed to an obligation on a commercial institution of some sort that may itself have a vault of gold or a vault of dollars, but ultimately that's a claim on a commercial institution, right, as opposed to a claim on a central bank, which is what we're proposing. We're also proposing that what we call the digital dollar, which is a U.S. central bank digital currency, be informed by distributed ledger technology in its distribution, in its architecture, and therefore the record, the mutable record, would be present. The question is how much anonymity or transparency to program into that development. And that's the key word there, is programming. Privacy in a digital environment becomes a design choice. And policymakers get to make that policy choice, conscious of Fourth Amendment principles of a right to privacy, conscious, though, of national security and anti-money laundering, anti-human trafficking, and law enforcement issues, and how to balance the two. It's a misconception that in paper cash money, there's full anonymity. That's a misconception, because there is full anonymity below a certain level. A design choice was made years ago that above $10,000, there would not be anonymity in the use of dollars in certain commercial transactions. Right. Again, design choice. So policymakers will get to make a design choice in developing a digital dollar. And I think that's, to Daniel's point, why it's so essential that we have a series of pilot programs to find what the right level is there. Now, I'm one who believes that if the United States gets this design choice right in a way that's consistent with our historical principles of the right to privacy from state surveillance, a digital dollar could actually be the world's preference currency compared to, say, digital currency developed by non-democracies, states that don't recognize the rights of their citizens to privacy, or against other states that may be more focused on restricting commercial exploitation of transaction information, but be fully open to state surveillance. If we get it right in the United States, and I believe we must, and I think we should, and I think it becomes a competitive issue to get it right, we could develop a digital dollar with the right level of privacy and yet the right balance of appropriate law enforcement restrictions. But again, it's about programming it in. And to finish on this point, the best argument, I think, for going to a digital currency is the ability to program in particular values that are important to a modern democratic society, program them in right from the beginning, both technologically and embedded in our law and jurisprudence as well.
Yeah, it's a great point. As I read the paper, I just kept thinking about, well, privacy erosion is sort of a one-way street. As you lose privacy in our society, and we're talking about through marketing and advertising, and our information is out there, it's kind of hard to put that back in the bottle. And I think what you're saying, as I understand it, the nice thing about digital dollars, we get to decide. You can set the dollar wherever you think is appropriate, or the policymakers think is appropriate.
Actually, if you look at history, rights to privacy don't always diminish over time. In fact, it's more often than not, in Britain, for example, there was no right to privacy until a modern middle class emerged, and they demanded those rights from their sovereign, just as our founders of our country demanded those rights from informing our government. So I don't believe there's a historical direction toward less privacy. It's important for us as we design our digital dollar, decide what those rights of privacy should be and make sure they're embodied in this new innovation for the future. And we shouldn't assume, and certainly I don't think we at the Digital Dollar Project assume a lack of privacy in a digital dollar. We're here to work to make sure that the right balance is built into it, and work with policymakers to get this very important element right. And besides, getting this important element right is a competitive advantage for the United States if we get it right. And that's all the more reason to get the balance right.
I think that's right. I absolutely think that's right. And something we as a democracy have been good at in the past. And I think we have to figure that appropriate balance. And talking about balance, another area of sort of the yin and yang of this is the sort of complete open source versus walled garden approach to, some digital currencies, they operate within their own sort of walled garden, and there's not a lot of interoperability. They don't play well with others, and so they're great so long as you're in that silo. And on the one hand, I could see a desire to have a digital dollar be kind of closed to prevent, whether it's state-sponsored actors or hackers or the others from, compromising our systems. On the other hand, the more open the architecture, the more innovation you're going to have, and probably the more businesses and other jurisdictions that will adopt it. So how do you approach that sort of walled garden versus, complete open source with the risks and benefits that go with those?
So maybe I'll start there and say, look, the point on interoperability is critical. I mean, so if you start off with the premise that the United States dollar is the choice reserve currency of the world, we certainly don't want to walk back from that. So you would want to develop a system that is interoperable with other major central bank initiatives as well. That's why one of the things that we've focused on doing through the Digital Dollar Project is to engage closely with other central banks that are pursuing their various pilots and trials associated with CBDC. At the end of the day, that's going to be really important. And there are certain groups like the IMF and World Bank, and you have BIS that are focused as well on interoperability. So we certainly don't want to create a system that walks back and creates an even more siloed type structure. That would completely defeat the purpose of what we were talking about at the outset, which is the internet allows connectivity of computers with relatively limited friction and relatively few intermediaries. So we shouldn't be adding those layers back in. And actually to make the point too, that if we view this and if we view tokenization of the US dollar as an offensive opportunity rather than something defensive in nature, there's a lot of opportunity even further dollarization. Now that's something that has its own set of challenges. I mean, there may be certain global emerging markets that would struggle with free access to tokenized USD. But certainly there would be a lot of advantages for end users and for consumers on the ground. So it is really important that as we design our systems, we think about openness, we think about interoperability. In my view, that just unlocks the benefits of tokenization and all of these trends and dynamics that Chris and I are talking about. So Chris, I don't know if you have further thoughts on that topic.
No, I think interoperability is critically important. It's one of the reasons why the Digital Dollar Project and its team and its advisory group have spent a fair amount of time talking with our colleagues in the UK, at the BIS in Switzerland, and our friends at the Riksbank, with others that are working on developing central bank digital currency. It's one of the reasons why it's so important that the United States gets started now, it's because these other efforts are underway and they're making good progress. If the United States suddenly wakes up 3 years, 5 years from now and says, oh, we now need to get in the game, a lot of the protocols are going to be developed. Now is the time for the United States to be in the game, working with others so that when, and I believe it's not a question of if, it's certainly a question of when, the world's major economies all move to a digital currency system, they're all interoperable with one another, that the core foundational architecture was set at this point in time. We think the United States needs to get in those games, and it needs to go further, however. And we at the Digital Dollar Project are certainly encouraging an ongoing dialogue with efforts underway elsewhere.
We're running a little short on time. There's a lot of topics I'd like to hit, but I'll try to whittle it down here. I'd like to talk about impact on the existing sort of market structure, banks and the like, and then maybe kind of some concluding thoughts on where, sort of procedurally and substantively what the next steps are. But on the bank point, you said something interesting, Daniel. You talked about, we built the highways, updated our infrastructure, and it had some impact on existing transportation businesses, but then there was just so much more that came out of that. I think of the banks as the existing transportation systems and the digital dollar. In your paper, you guys wrote, and I'm going to just very quickly read from it, unless the digital dollar is put into a safe deposit like storage or custodial solution, once exchanged for balances in a bank account, it's fungible with other monies as it is on a bank's balance sheet. This is important for several reasons, but one of the most vital is to ensure that consumers and businesses keep deposits at commercial banks. These deposits underpin the U.S. economy by enabling banks to lend funds to borrowers for activities such as buying a home, building a new factory, and everything in between. So, point well taken. Banks serve an important function in moving money through the system, giving people access to credit and loans and things like that. And I'm sure you've seen, it's really in the last 6 months, even though it's been going on for a while, this explosion in the DeFi world where, you can borrow and lend digital assets and earn a rate of interest on a digital asset. And what I like about a digital dollar is that if I want to control my money, I can store it. Now, it may not be appealing to me to store a big, suitcase of dollar bills, but I can potentially store my digital dollars as safely and easily as I can myself as I can with a bank. So if this comes to pass, what is the impact on banks? And do I even need a bank? Because maybe I can store it myself, move it myself. I don't need to use a wire, ACH. And maybe I can even earn interest through a third-party, DeFi type systems. So talk about that.
Kevin, it's a great question. And I'm going to say, at least from a retail perspective, I think that the quick answer to this is that the analog with physical cash holds. So the reality is most people don't want to hold inordinate amounts of physical cash because you would lack FDIC insurance coverage. It's not interest bearing if you bury it under your mattress or put it in a safe deposit box. The same, at least in our champion model, would be true of digital tokenized cash. You have a choice as a consumer to hold that in a custodial wallet, if you will, but understand that likely will not come with FDIC insurance and will likely not be interest bearing. Most people would choose to hold the proper balance or an equilibrium balance of tokenized cash in that type of a custodial wallet. But if you want to secure yourself FDIC insurance or the benefits of interest payments, you would be incentivized to move your money into a traditional commercial bank account, and you would be able to do so readily. That's actually one of the advantages of our champion model, is it would avoid mass disruption to commercial bank deposits. And one thing that I know Chris outlined at the outset, but to really underscore the point, this is also why we're not believers that at least the underpinning of this system should be where the central bank is offering direct retail accounts to consumers or individuals. That could displace the commercial banking system in perhaps a very disruptive way because of what you mentioned. Lending activity typically originates in our commercial banks. So the quick answer to that is at a retail level, consumers would have choice as to how they would want to custody digital cash, but it would be interoperable and exchangeable within the commercial banking system, which maintains that economic function.
A few minutes ago, Kevin, I mentioned that, looking at it broadly, the current accounts-based system is slow, it's expensive, and it's exclusionary. Some of the actors who are most directly looking at central bank digital currency and stable coins as a solution to that are the very banks who may become disintermediated to some degree by this innovation. And they recognize that, and they're experimenting with this new technology now. The technology, technology is it's like a driving wind. You can try to stand up against it, but it'll knock you down. Much better to harness it the way you do a sail or a plane, to do things with it. And that's what we're talking about. This technology is coming. There will be new opportunities for forward-leaning financial institutions. And some of them will be the old-fashioned ones of collecting deposits and paying interest on them, lending for a new home, lending for a new car, all the activities that banks do. But others may be things you might not even think of. I mean, right now, banks operate AML KYC functions as a back office loss leading function, where there may be an opportunity to move that into a front office on a white label basis for wallet providers who are going to need that function. There's also going to have to be those who can write, if the road is a distributed ledger approach, that those who can write to it are going to need to be included in a financial regulatory structure as well. There's going to be new innovations that are going to come out of this, just as new innovations came out of the internet, just as new innovations came out of the space program. New innovations will come out. And for those banks that are forward looking, who are already experimenting with it now, see there's going to be new opportunities and are going to go with that and develop the money of the future.
Excellent. We are almost out of time. I wanted to just kind of to close out. I'm at Delta Strategy Group. We work with a lot of financial market participants and digital asset blockchain companies, and I know there's a lot of people in those circles who are talking about your white paper. A lot of our clients are talking about it. They're potentially formulating, comments or things like that that you've called for. But what are the next steps procedurally and substantively to get to a decision on whether it's the challenger model or there's some other path, and sort of how do we get there? So where are we now and where are we going? I guess so. I'd like to close it out.
Maybe we'll do this as a two-parter, and I'll do the first part, and Daniel would do the second. I think the first part of that is, where are we now? Well, I'm proud to say we've come a long way since Daniel's in my op-ed in the Wall Street Journal last October, when we're hoping to build a consensus around the need to explore a U.S. CBDC. And in that period of time, even Chairman Powell, just in the last few weeks, said that the United States needs to be in the first rank in developing this. Governor Lael Brainerd has said something similar. And at the international level, you see people like Augustin Carstens and others at the BIS also saying that. The consensus is building that this needs to be done. And the global consensus of our allies is the United States needs to be in that game. And that idea is getting around. So I think the idea has come a long way in a short period of time. What's next, however, is to now take a building consensus that the United States needs to play a leadership role to bring that back down to actual, how do we get there? How do we take leadership? And Daniel might want to speak to that.
Yeah, look, I'll end kind of with one of the pieces we started with is the importance at this stage of real world pilots and trials. I mean, I think that there's been the right amount of talk and thinking going into, what are the champion models? What are the purported benefits? What are some of the risks? And a lot of great thinking and publications have come out as a result of that. But now it's time to see where the rubber hits the road. So we're certainly proponents in starting to test in the retail context, in the wholesale, in the international context. Let's start to see what tokenization provides by way of benefits. There are going to be some other meaty topics like around privacy, around the rails, which we had a chance to start going into here. But, how does blockchain or DLT help inspire or build the rails that we're going to need to actually move a tokenized dollar. So we need to now get kind of beyond the rhetoric, and it's going to be really important to see trials, hopefully sponsored at the public level, but certainly the private sector will be partners in that, and the private sector can help to drive some of it too, to actually start developing empirical evidence and information about what tokenization can provide.
And Kevin, I'll end with one note, and that is that there are some that might think that this is such an important project that it needs to be done exclusively by the official sector. I would counter that and say this is such an important project. It absolutely needs to be driven by the official sector, but with enormous amount of input from the private sector. That's how the United States was able to land on the moon. That's how the United States was able to build the internet. When the United States does big things, they're a combination of private sector expertise, innovativeness, and sense of urgency, and public sector concerns for the public interest and setting down the right policies. And that's what we've got to bring to bear here if we're going to build what is vitally important, I believe, for the future of the dollar and the future of money, is that the values of democratic values, of free enterprise, of the rule of law, and the right balance of privacy be brought to bear in the future of the US dollar.
Excellent. Excellent. Well, thank you both so much. I really appreciate your time, and I know our audience does too. So we'll wrap up, and good luck to you both, and I look forward to learning more about the Digital Dollar Project. Thanks.
Thank you.
Thank you, Kevin.